Good evening, ladies and gentlemen. I know I stand between you and drinks, so I will try to be succinct in my remarks. Let me start by thanking the ICMA for the invitation to be here. And being from China, there are very few of us who are able to make it out here. I've got a number of colleagues in Shanghai who would have loved to be in Vienna with us today. I think that storyline reminds us that COVID is still very much with us, and that is sort of the first theme that I'd like to start with. What COVID has done is reminded us how critical and how important multilateral development institutions are. You have seen early on a couple of representatives of our universe of institutions. We had Denise, who moderated the earlier panel with Andrew Cross, Denise from the IFC, Andrew Cross from the AIIB. We also had Bertrand from European Investment Bank. That is the universe of institutions that I'd like to just talk about a little bit, because I think they've got a vital role to play in the sustainability revolution. What COVID has done is really re-emphasized and reminded us how important these institutions are, because we often take them for granted. And just to reflect, to remind you, it was only 77 years ago, to be exact, that the first multilateral institution was established. That's the World Bank together with the IMF. And over the last 7 decades, a number of others have emerged: Asia Development Bank, African Investment Bank, European Investment Bank, and most recently, New Development Bank, Asia Infrastructure Investment Bank, and so on. These institutions combined have an asset base of just over $2 trillion. So in the sense, in terms of the overall financial markets, it's really sort of a drop in the ocean. However, they have a very critical and a magnified role when it comes to the transition to net zero. So what I want to talk about now is just what I see as some of the 4 or 5 key trends that are emerging around these institutions, and what are the changes that are driving that. The first point I'd like to make, and no less than Janet Yellen at the IMF World Bank spring meetings 2 months ago, said that these institutions have to move beyond the status quo. And I quote, essentially what she said in that speech in Washington was that the institutions should look at embracing more risk and using their AAA status or their very high credit worthiness in more imaginative ways to enhance their development impact. Now, may I remind you, many of you in the audience, look a little bit sort of older, or look at least sort of my age. Those of you who were around in 2008 or before will know that there were many other AAA rated institutions in the 90s and in the early 2000s. Today, we only have about a dozen or so of these institutions. New Development Bank is a AA+ institution. All the others I mentioned, EBRD, AIIB, ADB, and so on, are all AAAs. The key question that Janet Yellen asked, really, and this is the first trend that I'd like to highlight, is whether we are optimizing on the high credit worthiness of these institutions. We are the last people, can't use the last man standing, the last person standing in the club of AAAs. The G20 recognized this as well, and under the Italian presidency of the G20 in October last year, it was recommended that a special panel be set up who have just completed their work a week ago or so and will make their findings public. And they've examined whether the capital adequacy metrics, the risk metrics, the leverage, all of the things that determine that high credit worthiness, whether those are maybe too conservative. So we are all looking forward to that report, because it might signal a change in the approach to risk that our institutions take. So that's the first trend that I'd like to identify, which is about embracing more risk, using more instruments like credit enhancements, using more guarantees, going beyond the traditional way of just providing debt in the form of loans or equity in the provision of infrastructure finance. The second point I'd like to make, and again, this is against the backdrop of COVID, what COVID has done really is reinvigorated this idea that we need institutions that are focused on dealing with global public goods. The pandemic is one, climate change is another, dealing with refugees today here in Europe is another, dealing with cybersecurity, all of these types of challenges that go beyond national borders. The world is not actually optimally organized around dealing with these challenges. And this is where multilateral banks have a very critical and decisive role to play. Just to remind you, the total capital, share capital of these institutions, the leading ones, comes just to about $50 billion. Yet these institutions have raised or have lent in total more than $1.7 trillion over the last 60 years. That shows how effective the business model of MDBs really are. With a small amount of capital, share capital, we've been able to raise from the debt capital markets huge amounts of money on the back of a very high credit rating. So we've got low cost of funds. We add a little bit of a spread to make some income. We don't pay dividends really, but we reinvest that income we make over time into reserves and then on lend for more projects over time. So the model works perfectly well. The question is, isn't there more that we can do to make the MDBs even more effective? The next trend that I'd like to highlight is what I would broadly call moving away from provision of capital or loans towards public sector and state-owned enterprises towards the mobilization of capital and more using our power to catalyze, to unlock and raise more private sector capital. So today what you have is MDBs moving away from lending to state-owned enterprises and using their power to generate more private sector capital. We've heard from BlackRock, from many institutions here who are dedicated and committed to devote more resources towards sustainability. What we would like to do as multilateral banks is to enable that, is to change the risk return profile of projects, to provide, for example, first loss guarantees, to use our equity, to use our ability to raise grants from development finance institutions to take on the riskier parts of infrastructure projects, and in that way mobilize additional institutional investor capital. A third trend that I think is already sort of underway is MDBs are developing new financial instruments beyond only green bonds, social bonds, sustainability-linked bonds. I might also want to just remind you that it was our institutions, the World Bank and the EIB in particular, who pioneered the first green bond in 2007. Today, that market has developed to over $1 trillion, and I would argue today that the social and sustainability-linked bond market is at that embryonic stage of where we were in 2007, and we can play a great role to magnify the scope and size of that market. So I foresee over the next year or two that we will do a lot more to use our ability to pioneer new financial instruments in the sustainability space, including, for example, blue bonds, which is an instrument that the World Bank issued just over a year and a half ago. Just to again flag how important, just when I opened Financial Times, which all of us read first thing in the morning, there was a letter from the Treasury in the United States, Janet Yellen's team, criticizing the World Bank in an open letter that they are not doing enough in raising their climate ambition. So we feel the pressure as multilateral institutions to raise the bar, especially after COP26, where a much higher platform was established and expectations have been raised for us. The final point the final 2 points that I'd like to make is that we also see our role moving beyond setting our own individual targets to what we call the creation of markets. So in the past and currently, if you look at our websites, you will see that we have targets of 40% of our exposures will go towards climate finance. What we now want to do, instead of setting our own internal targets, is more look at what role have we played to green the entire financial and capital markets in the respective jurisdictions where we operate. So again, the aim is to significantly increase the scale of our impact. And maybe just to close off, what I'd like to say in conclusion is that the potential for MDBs to move beyond their AAA rating, or let me put it differently, to rather use that rating in much more imaginative ways, even if it means going down one notch in the rating spectrum. And let me just give you a quick example to end off. When I arrived in China in 2015 to set up the new development bank with a few colleagues, we had nothing, no staff, no technology. Only thing was a commitment with capital. We had $50 billion of subscribed capital committed from 5 member countries. And I remember very clearly what the president of the bank at the time told me, because I was responsible for the bank's credit rating. He says, design policies so that you look like a AAA, feel like a AAA. In every respect, you must be a AAA. So what that meant literally was creating or reproducing all the policies, very conservative liquidity metrics, risk metrics, all of those were put in place. And we managed, without any AAA shareholders, not a single one, we managed to obtain a AA plus credit rating that has never been done ever in the last 70 years. The only institutions that are AAA have Western European countries as shareholders, Canada or the United States or Japan, traditionally AAA countries. The lesson from that is that the rating agencies have been incredibly conservative in the way that they have designed their methodologies, and there might be scope to re-engineer some of those methodologies so that we can unleash more public finance into the sustainability revolution towards net zero. Thank you very much.